Good evening, fellow traders. Welcome to another episode of my trading journey that I'm sharing with you and questions that people ask based on popular request. I'm going to talk today about spreads. Then I'm going to talk about the commodities, then the indices and the features. What are features? Because you have features on the indices or CFD features on stocks, and you have the features on the commodities also, like the gold and other commodities. Then you have also currency features as well. So I'll start by talking about the spread. So when we say spread, what is a spread? When you are trading as a trader, what is the spread and why is the spread so important? The spread is really something easy. Let's say I'm looking at the gold chart here. So you see the difference between the bid and the ask, or the sell and the buy. You see there is a difference. When you subtract, the difference is what we call the spread. So you can see if you want to sell silver now is 22.37, and if you want to buy silver now is 22.430. So when you subtract these two, the difference is called the spread. That is why normally when you place a trade, your trade starts in negative before it goes into the profit, because the broker is taking the spread before even you start your trades, as the trades gets into. And there's also the spread might vary from broker to broker. I mean, if you are an FTMO trader, you can see, especially if you look at their US 30, it's about 100. First it was about 150, which I have never seen that before in my life. I have never seen a lot of big spread like that, because it's I've used ETS, I've used CMC, I use IG index, I use IC markets, different brokers, but even I have my own platform on Ninja Trader, and this is the first time I see big spread on the FTMO platform. Most of them are ridiculous, and sometimes the broker might deliberately increase the spread during certain times to prevent especially small traders from taking orders. So let's look at another example. We look at one commodity. So if you go to new order, this is Euro North Korea currency. So you can see the bid and the ask, the sell is 10.5941 and the buy is 10.5942. So you can see the market is moving, so the spread might change. So when you subtract the two, the difference is the spread. If we go and look at the Aussie USD, you can see it as well. So you have the sell and you have the buy, or the bid and the ask. So when you subtract the two, the difference is the spread. Okay, so this is something easy. It's not difficult to understand. And once you place the trade will start in negative. Whether you are buying or selling, it will start in negative, because the broker will take the spread before your trade will start. Whether your outcome will even be in positive, net positive, or net negative as you close the trade. Okay. Yes. So, and let's go and look at the indices and check the spread also from there. And this button, how you get this view here is when you go here, view, and you click market watch, this will come. Okay, if you don't have anything, all the things that you want, you just right click and you click show all, and all the market that the broker will allow you to trade is there. So here you can see I'm allowed to trade on this platform stock as well. So you can see this is Henneken. So this is the difference. Bid and ask to be about 2 or 3 point something, as you can see when you subtract the two. So that is all what it means by the spread, and you can see more of those things coming. And when we look at the indices, looking at the Dow Jones. So the you see is 295.7, and so when you subtract the two, the difference is the spread. And most times also midnight, when it is midnight, before 1 a.m. and stuff, sometimes the spread of certain assets will start to be more. So having said that, we'll talk about the indices, we talk about commodities, and we talk about currencies, and we're going to talk about the features, as we say. So what are future contract trading on the financial instrument? It's not anything difficult. It's just a contract that has an expiration date. And there are two. You have the near contracts and you have the far away contracts. So you, the trader, you decide to trade. If you are trading a feature and is nearing the expiration contract on this one of this MT4, MT5 platform, and you want to roll it over into the next contract because you think you are riding the trend, then you have to tell your broker. So if it's expiring, let's say that tomorrow, and you want to keep holding the trade throughout December contract or January contract, you just tell your broker and they will roll it out for you. So this one has no expiration because this is not a features indices. This is just the normal ones we are trading. And what do we mean by the Wall Street 30 is the Dow Jones Industrial. So that is the 30 biggest companies trading within this exchange. Yes, and then you have the Nasdaq. That is the Nasdaq. That is the top 100 technology companies in this. So sometimes depending on how individual companies carrying the weight perform will determine the overall trend of the market, because if you have the biggest companies in this 100 of them, the biggest one are making more profits and stuff, and they are rising, it will pull the indices up. And if you have majority of them or the biggest companies in them, their stocks falling, it's going to decline. Yes, but overall, you look at your technicals, which is your analysis or the system you are using to trade. So when you say features contract or features on indices, you don't have to let it scare you. And when you talk about the German 30 or the DAX index, that is the 30 companies, top companies in Germany. They form this index where you find BM and all the other top dogs there. So yes, so you can see the spread, it keeps changing at times. Yes, because the market is moving. Yes, so you have the UK 100, which is the top 100 companies in the FTSE or the UK 100, and they have the FTSE 250 as well. Yes, so depending on what is happening, that is how you get to know the companies are performing, and the trend is coming up or is coming down, depending. And if you see expiration dates in any of the things that I have spoken about, then it means it is in the futures market. So if you are buying April 30, it means the contract or the trade you are in is going to expire on April 30. But that does not prevent you from cutting your losses or closing your trade in profit before the expiration date. Okay, before the expiration date. So that is very simple. When you come to the commodities, the same. Gold, silver, oil, there is pork belly, orange juice, soya bean, cocoa, coffee. All these things are traded, but on the real futures market, those people buying these things take delivery of it, because it's a physical things that are traded, but you can't take delivery of the currencies or the indices. But the real futures market is the commodity market. Gold is physical, silver, orange juice, pork belly, coffee, or rice, cocoa, copper. All these things are traded. Oil, you take delivery. the real futures market, they take delivery, but here we don't need to take delivery. So they've created these derivatives here for us to take advantage of the movement, whether it's going up or it's going down, for us to take. But on the real futures market, these are real features instrument, things that you can see, cacao, silver, all these things traded. So you take contracts, so you have the right to sell or buy something that doesn't belong to you, but then the owner have the right um, to demand it, and when they demand it, you have to deliver whatever you've taken. And you come to the stock market as it is. The stock market, you can trade the CFD features as well, and it is the same. And when you are taking normally futures contracts, people are traded with margin. Margin means the broker will borrow you money, which means you have less money, but you can control large proportion of the market. For instance, maybe if you have 10,000, you can control 100,000 or more depending on what you are trading in the broker, which means that the broker is giving you some kind of loan. And if the trade doesn't go in your favor and you lose more than you have in your account, then you're going to get a margin call, which means you owe the broker, so you have to top up your account. So normally when you talk about real futures trading using margin, it is done by advanced traders, people who are sophisticated investors and they know what they are doing. And even on your normal currency trading or CFD trading that you do on the forex and stuff, you can still get a margin call. Let's say if you deposit 5,000 in your account and you are trading even, let's say, only currencies, and you take a couple of losses and you lose, let's say, 6,000 or 5,005. You deposited 5,000 and you've lost 5,005. So then you have a margin call of 500 or 1,000 pounds, which you have to give it to the broker. So it's more like you owe the broker. So you have to understand what you are doing before you use any of this complicated especially if you want to do real futures trading. So I hope this video is helpful. And when we talk about the currency, you can see the currencies, these are pairs. So you are trading the pound against the New Zealand dollar, you are trading the euro against the USD, or one currency pair against the other. But when you talk about currency features, you are trading only the euro. Okay, you are trading only the yen. You are trading only the pound. You are trading only the USD. Those are real currency features. So you are trading them, and they have expiration date along them as well. So you have to always check the features contract. But we trading here, we are interested in making money. So yes, you might have the features contract here on the commodities, but if you are buying oil or you are selling oil or gold, you are not taking delivery. You are not taking delivery of the market or the product you are buying. Yes, so we have to be careful of what we are doing. I hope this video is helpful to everybody, and I hope you understand what you are doing. If you don't understand anything and you need any help, just get back to me. So remember, when you hear about the spread, is just the difference between the bid and the ask, or the selling price and the buying price. When you subtract the two, the difference is the spread. I hope you are okay, and take good care of yourself, and I'll see you soon. Thank you, and have a wonderful week, and enjoy your trading. Trade carefully and be patient. Bye bye.